Hello again, it's Michael Hession from Private Banking Strategies, and in today's video I'm going to talk about how fractional banking works. And we're just a further exploration of the book, How to Grow Rich with the Secret That Banks Don't Want You to Know. And this is about how banks really make their money and how you can do so for yourself. So let's jump right into it. So not everyone knows the degree to which banks are able to leverage us when we make deposits into their banks. So let's take a look. Let's say, for example, someone were to put $100,000 into a savings account, and the bank would pay you an interest rate for that privilege. And let's go with 1%. That might be a little high. There are some out there that are a little bit higher, but we'll go for 1%. It's not much. Now, this is where people don't really understand, and I think it's important to know that banks are able to lend out multiples on what's actually put on deposit, up to 10 times as much. So in this case, $100,000 goes in, and they're able to lend out as if there was $1 million in there, which doesn't seem terribly fair, but that's how it is. So what do they do with that money? So, for example, they may lend out for a new home. The mortgage goes out at 4%. They get that money back. The house gets sold. Seller gets that money. It goes back to the bank. Either way. In this case, let's say they lend out for a dealership at 8%. Dealer marks up a little bit, sells the car, money goes back to the bank. They get that 8% comes back. It's like I said in the last video. Put money out, add interest, bring it back. Lend it out at interest and bring it back. Rinse and repeat. House remodel, 9%. Contractor pays it back to the bank. A debt consolidation at 12%. The credit cards go back into the bank. So on this example, for the $100,000, they're able to lend out $1 million at a variety of interest rates for a variety of projects. There are a couple of arguments as to whether or not this is good. On one hand, it does provide liquidity. People do need to borrow in order to get things done, buy homes, do building projects, get cars, whatever the case may be. And that's not really the issue so much. It's what they make you do in order to get access to that money. Obviously, high credit scores, liens, first position liens, especially for business type loans. The point is they have such an advantage over us because of what they are and who they are, and their position. And it's not really fair, and unfortunately it is the way it is. But there's that, and then there's also this. So let's just say, in this case, they actually made 3% on that home because they had to pay you the 1% for the right for them to hold that $100,000. Here's the case of the car loan, 8% minus 1, 7%. In the case of the house remodel, 9% minus the 1%, 8%. And then in the case of the debt consolidation, 12% that they're getting, and then they have to give you the 1%. So that's 29%. So at first glance, you might think, well, they're making 29% as opposed to the 1% they're giving us. That's not too horrible. It's not really fair, but But the thing is, that's not right. They're actually making 2,900% more than you at that 1%. Sometimes percentages can be a little wonky, but it makes you go, So the good news is, while we can't really operate quite like this, we certainly can't lend out multiples. We have to be more responsible than that. we can actually operate our finances similar to a bank, where we close the loop, uh, build our bank, lend out for things we need, car purchases, whatever it might be, buying debt, and then we bring it back and pay it back into our system and operate in a similar way that the bank does. And we turn outflow to inflow. And when you start to do that, just magical things can happen with your financial situation. So that's it for today's lessons. Until the next one, have a good day, and don't be too discouraged by this, because there is a way to replicate that for yourself. Okay, take care now.